All right, Lowe's just out with its quarterly numbers. Looks like the company came in with numbers of $1.04 a share. Street was looking for 98 cents. Same-store sales up 1.5%. And then the guidance that they're talking about, $5.08 to $5.13. Street was already at $5.15, so we're going to dig a little deeper into these numbers, try and figure out why they are issuing guidance that would be a little below what the Street's expectations were when they are very handily beating this quarter's numbers. Joining us right now with some reaction is Brian Nagel. He is senior equity analyst at Oppenheimer and Company. And Brian, thanks for being here.
Well, thank you.
You're in the hot seat because we literally just got these numbers, and I haven't even dug through myself to try and find out why they are talking about this guidance that may be a little bit below what the Street had anticipated. Let's talk first of all about this quarter. 104 versus the 98 cents the Street was expecting. Same-store sales up 1.5%. What does that tell you?
So if I look just at this quarter, and I think the numbers we should focus on here, and I was just digging through this as well.
Yeah.
I think it's $1.05 in earnings, and then a domestic comp of 2%. So
I've got 104 on an adjusted basis.
Maybe that's, let's see, I've got. I'll go with your number, 104.
Okay, so yeah, I'm just looking through some of the same stuff right now. And obviously, these are literally just hitting as
right.
we're trying to dig through.
So in and of itself, those numbers are okay. I think the 2% comp is a bit light. We and others had expected something closer to 3. But I think the bigger, and as I'm looking through this release now, there's probably the bigger message is all the other strategic efforts they're putting forth. Remember, I've talked about a lot, new CEO Marvin Ellison, at one time in his career was at Home Depot, joined Lowe's in early July. So now we're learning that they're exiting the Mexico business. They've already announced they're exiting Canada. So there's really this streamlining focus going on. And I think to me, that's the real big takeaway here, is that they're further streamlining this business to really focus on their core operations.
And you're pleased with what you hear about that?
I think it's a good idea because for a long time, I think one of the issues at Lowe's is they've been too focused outside what they're supposed to be doing, and that is the core domestic home improvement market.
Just to talk a little bit about what they are also saying, they say they expect to see positive trends as we enter 2019. Doesn't sound like they're warning about sales, but if they're looking at earnings being down for the full year, that probably means they're going to be spending some money to pay for some of these initiatives that they're just talking about. And maybe that's why we're not talking. They say 508 to 513 is what they see for earnings for the full year. After just beating by 6 cents in this recent quarter, that means earnings for the fourth quarter are going to come under a little bit of pressure if they don't make the 515 the Street's already at, right?
Basically, and I would say, and I've got to dig through it further, there's probably some extra expense in there. But again, I think that's largely transitory at this point.
So you're not worried about that. And again, this is about the new leadership from Marvin Ellison and what he's doing.
That's correct.
What else do they need to do? Because you've talked about what you'd like to see. I think a lot of it is in the back office and the logistics and management of just some of the things at Lowe's too, right? Well,
look, it's if we line up Lowe's versus Home Depot. It's very easy to see that Lowe's stores are less productive. Now, there's a lot of reasons for that. The sales at Lowe's stores are not as good as they should be. So I think if there is a company, they're more focused now on their core operations, the domestic home improvement business. That's going to help. I've written a lot about over the time, just the labor model in the stores. I think they need to work on that. I think they need to work on inventory management, merchandising, maybe marketing. It's a lot of little things. I don't think there's anything if I think about Lowe's, I think the real opportunity here for investors is there's not something drastic that has to happen. It's a lot of blocking and tackling.
Just reading through, and indeed what we were kind of guessing was the issue is the issue. They do say that there are going to be some additional charges associated with the intended exit from its Mexico retail assessment. Those charges with the strategic reassessment are why the numbers will be a little below what the Street had been anticipating. But if you look at comp store sales, they're expecting an increase of 2.5% for the fourth quarter. They're also looking for total sales expected to be up by 4%. And they say that operating income as a percentage of sales, their operating margin, is expected to decrease 240 to 255 basis points, including 135 to 150 basis points just from the strategic reassessment charges that'll be associated with that. Anything in there cause you any concern, or does that sound about right?
That sounds about right. I mean, that type of comp is a decent number given the more difficult comparisons last year. And then again, below sales, there's a lot of noise right now with this transition of this business model.
Okay, Brian, I want to thank you very much for coming in. It's good to see you.
Thank you. Nice seeing you.